Welcome to Tea at Taxevity, where you meet people who make life better, our clients and friends. My name is Pramod Sharma. Today our guest is Clark Steffy. He works at Industrial Alliance, where he is the Regional Vice President of Pensions and Retirement. Basically, he covers all of Canada except Quebec, so we're really lucky to have him with us. I worked at Industrial Alliance also until 2009, but I didn't meet Clark. That's because he's on the pension side and I was on the life and health side. We got reintroduced through the very first guest at Tea at Taxevity, David Peck, who has known Clark for 25 years or so.
Yes, in fact, I've known Dave for quite a long time. He was my roommate's best friend in university.
Talk about a small world. Our topic today is retirement plans for small business owners and professionals. Now, Clark, when I think of pension plans, I think of RRSPs. What are the pros and cons of those plans?
Yeah, in fact, Pramod, many people think of in terms of RSP really being the only solution. But pension plans add a totally different dimension, especially for business owners who can set these up for themselves. And some of the benefits of a pension plan would be the ability to put more money in than the RSP limits allow, the dollar limits.
Okay, so why can people put more money into a pension plan than an RRSP?
Well, there's the defined benefit format of a pension plan, which is very useful for business owners that are closer to retirement. And the defined benefit works in a way that has a fixed target that you're trying to hit. And so as you get closer and closer to retirement, the time value of money does less and less for you because you don't have much time left. Mm-hmm. So the heavy lifting has to be done in the contributions. You have to put more money in. And this is why many corporations are getting out of defined benefit for their employees. So the only people setting up defined benefit plans these days are pretty much business owners for themselves because of the extra tax sheltering that it provides.
Okay, so that's considered the best quality of pension plan then?
Certainly provides the largest pension and the best tax deductible way to move money out of your business into your own name in a very in a tax protected and a creditor proof environment.
And probably the most peace of mind for the recipient.
Yes, for sure, because you're guaranteeing a pension to yourself.
Okay, so RSPs are the standard pension. Now, what are the drawbacks or advantages of an RSP? Is that the first place people should start, or should they be looking at other options?
Well, I think if you're a business owner and you've had a higher income, paying yourself a higher T4 income than the average person, mm-hmm. You should consider this defined benefit format of a pension as opposed to an RSP because of the extra tax contribution room that it provides. And in fact, as we talked about before, Pramod, I often ask advisors to, the single question, if your client was to answer the question, if they had more RSP room, would they use it? If the answer is yes, then that probably the IPP is something they should consider because it creates much more tax sheltering than an RSP for the business owners who have a very high T4 income.
Okay, so the IPP is the individual pension plan, and how does that work?
Yeah, so the individual pension plan, and again, we've jumped from defined benefit pension plan to IPP. I apologize for that simple skip, but an IPP is simply a one-person defined benefit pension plan, or sometimes they're set up for a husband and wife business owner or even their kids. So it's a small group of executive business owners becomes an IPP, individual pension plan.
Okay, so with the IPP, because I'll use the terminology too.
Sorry for all the acronyms.
If you don't know what it means, then just rewind this and listen to the segment before.
Yeah.
Okay, so with that, it's a defined benefit plan, which means the recipient has a pretty good assurance of what they'll be receiving. And now with an RSP, I think that's a defined contribution plan.
Yeah.
And how does that differ?
Okay, so defined contribution, you know how much is going in.
Okay.
A typical plan that an employer would offer in the defined contribution world, such as a group RSP, would be that, let's say if I put in 3% of my money, of my pay, the company is going to match that. So 3 plus 3, 6% goes in. But you don't know what that's going to grow to.
Okay.
Based on interest rates and rates of return and the funds that you might be investing in, you have no idea what the benefit is going to be. You just know what the contribution is. So a defined benefit, to start back to square one, if we can use that term, is to really set a pension plan based on what the benefit is going to be. What you don't know is what the contribution is going to be. And that's where the funding, if you're closer to retirement, can be much, much higher than in an RSP or a defined contribution pension plan.
Okay, it does sound like an IPP is a superior type of vehicle. I don't want to say it sounds too good to be true, but are there some drawbacks to using that structure?
Well, there are some drawbacks. One is there are some additional costs. In a defined benefit plan, you need to hire an actuary, which you are an actuary, promote, but you have to hire an actuary to do a valuation every 3 years.
Okay.
And Canada Revenue Agency, CRA, prescribes the rate of return you're going to assume. It makes you assume a 7.5% rate of return. So every 3 years, the actuary has to crunch the numbers and see if in a defined benefit plan, whether you're hitting that target. And then if you haven't been, you're in a deficit position and you could say you have to, but you could also say you get to put more money in, which creates more tax funding, which is one of the reasons why we did this in the first place, was to try to get money out of our business into a tax-sheltered vehicle. So that could be a good thing. But if you earn a rate of return much higher than 7.5% return, then you're in surplus, and that could reduce future funding.
Okay, that's interesting. It would be really nice if CRA would guarantee we could earn the 7.5%, but that's not how it works.
Not how it works. But I often tell people that, and very few have actually bought into my strategy here, but I think it makes a lot of sense, and is that if you have other assets, if you're a wealthy business owner, you likely have non-registered investments, other RSP assets, that you can be more aggressive with those and then be more conservative with your individual pension plan or IPP, which will generate more funding and more tax deduction and more money out of your business into a tax sheltered vehicle opportunity in the future. So you can engineer that based on your needs and based on your total holistic financial planning strategy.
Okay, so you're investing more safely, which means that you're less likely to earn the 7.5%, at least these days. Right. And that means that because you're guaranteeing the benefits, you have an opportunity to put in more money.
Yes, exactly. And in fact, a lot of people say 7.5% in this current interest rate environment with interest rates so low is quite unrealistic. But we recognize that CRA is not looking to give more tax breaks to wealthy business owners, so they're not going to drop that interest rate to a lower rate at this time. Now, every 3 years, you will get to put that money in when the actuarial valuation determines that you haven't actually hit the return, that the 7.5% prescribed rate that CRA set.
Okay, now in terms of the cost, my understanding is that actuaries are pretty expensive, and then you also need to have, I think, a pension plan administrator. Like there are a bunch of things that are required. Is there some cost-effective way to get all of those services without surprises?
Well, in fact, that's one of the differentiating advantages of the Industrial Alliance service, because we've created the bundled IPP. So we do the custody, the investments, the actuarial, the record keeping, the administration, all in one bundle. And, and the cost is quite low. We charge $1,100 per year, and that covers the setup costs, the actuarial, the triennial actuarial valuation. That covers pretty much the whole thing, except for the investment management fees that the member pays out of the on the investments that they have. But it does not cover amendments and extra actuarial work. But it does cover all the core services. So it's very efficient. It's a very efficient model.
Okay, because sometimes there are good ideas, but then people get scared off because they have no idea what it would cost. And if you've got something that's at a fixed price, then that gives more peace of mind.
Right, and I think the one-stop shop is also powerful, because if you were to go out and find your own actuary, find your own trustee, find your own investment vehicle, find your own administrator, and then try to bundle that up by yourself, that's where it can get very pricey. So our bundled solution, I think, has really added a lot of value to the marketplace, and we're really probably the leader in this space. We do about 600 IPPs across Canada.
Okay, great. Now, okay, so we've talked about RRSPs, we've talked about IPPs. I've heard of this thing called a PPP. So what is that?
Too many acronyms. So the PPP is a new innovation. It stands for Personal Pension Plan, and it's just a brand name that we've created. And so it's actually a combined defined benefit and defined contribution solution.
Oh, how does that work?
Well, it allows the member to select in any given year, prior to the year starting, whether they want to go with a defined contribution plan or a defined benefit plan.
For that year?
For that year.
Okay.
And the reason you might want to do that is because, let's say you have other investment needs. Let's say you want to buy a boat or fix your cottage, or let's say you're having a down year in terms of earnings. You can simply opt into the minimum amount into a defined contribution, which is only 1% of your earnings. So you can make a very small contribution in a given year, rather than the very large contributions, which was the reason why we probably set up this plan, because you wanted to get the tax breaks. But let's say you needed a break from these tax breaks because you don't have the money right now. You could just opt for defined contribution minimum 1%, which is the minimum pension contribution you have to make to keep it running. And then whenever you're ready, you can just go back to defined benefit. And in fact, you can go back and pick up those years you missed.
Okay.
And buy past service for those additional years.
Now, if a company were using just the defined benefit aspect, and it turns out this year is a little lean, and they have difficulty making the contributions, what happens then?
Well, we only set these up for business owners. So business owners can always let themselves out of these commitments. The problem is that you still have to amend the plan and do the actuarial valuation. So this PPP solution just avoids a lot of the amendments and all of the rigmarole. It just allows you to opt into the 1% minimum DC plan, defined contribution plan, until you're ready to go back to DB without all the machinations of changing the amendments and that are required, because hey, this is a pension plan, so there's some filings that need to get done and number crunching. So it's a real efficiency to add on that layer. And I always say to people, 95% of the IPPs that never got set up were just because it looked like too big of a commitment. So this simple PPP solution to opt into the lower contribution amount seems to be a really interesting innovation.
It does sound like a good innovation in a space that could use innovation.
Right.
Now, there's also something called an RCA. What's that?
So that stands for Retirement Compensation Arrangement. And these are really executive plans for people who want to exceed contributions, even in a defined benefit pension plan where the contributions are much higher than an RSP. If you're close to retirement, this will take you even higher. And so these are more non-registered, less tax effective. So the core strategy is the pension plan.
Okay.
But if you see the maximum pensionable income in 2014 is $138,500.
Okay.
If your T4 income is higher than that, it doesn't help you build a bigger pension. So let's say your T4 income is $500,000. Then you can do the excess of $138,500 into an RCA contribution to buy basically a pension for those missing T4 incomes, on the same format as the defined benefit, the IPP. So it's for the excess of the pension where you want to get a higher pension, because there's a real discrimination against people who earn higher T4 incomes because of the dollar limits that apply in the pension regulations.
It looks like there are some good options available to people who are doing well in their businesses. Now, if people want to know more about these strategies, then what's the best course of action for them?
Well, I think the first step would be to contact your financial advisor. And certainly you could contact us at Industrial Alliance. We would route you back through your advisor likely and work with them, because I think it's important to look at these things holistically. we often recommend that you involve your accountant as well, because this gets into tax planning, whether how much of your income you should be taking as dividends and how much you should be taking as T4 income. These are all strategies that you should have your accountant involved in, but certainly your financial advisor, and you can always contact me at Industrial Alliance, 416-585-8068, or clark.steffy@inalco.com.
Okay, well, thank you for sharing your information with us, Clark.
Thank you, Pramod.
Thanks for joining us for Tea at Taxevity. The Taxevity Insurance Advisory helps you understand insurance and bridges gaps in your coverage. There's no premium for peace of mind. How healthy is your insurance?